All right, so technically, it looks like we have seen a new all-time high for the S&P 500 in intraday trading, even though the index on the day is only up about a 0.5%. Feels like for weeks it has been trying to get back into record territory. And interesting to see that happen on a day where we're talking about inflation on the rise in the US. Isn't that something that holds back certain stocks? Let's get some perspective on all of this from Rob Tetro of the Tetro Advisor Group at Canaccord Genuity. Rob, good morning to you. I guess let's start with where we are in the markets because this inflation story had been a bit of a hiccup, particularly for growth stocks for the longest time. How would you interpret this morning's reaction to the inflation picture in the U.S.?
I'm a little surprised, John. Thanks for having me again. I really appreciate you guys having me on here. Enjoy coming and chatting with you about the markets once a month. I'm a little surprised. I must say, in the past, when we've seen disappointing numbers on inflation, typically the market reacts. You would expect to see some sort of hiccup, 150, 200, 300 points down on an inflation number this high. I guess every time you see that, market expectations, the street is expecting, sometimes it's not a real number, right? I guess that's what I would attribute this to, because this is concerning. This 5% inflation number is concerning. I recognize it's not all kind of core inflation, but regardless, it is concerning. We do know that historically they've tried to be around that 2%. And I mean, when I saw the number, I immediately thought we'd be down 300 and we're not. So I'd say it's concerning.
All right, and let's just sort of take the bigger view outside of the inflation debate at this point. I mean, certainly for the S&P 500, off the lows from March of last year, we're talking about a rally that is pretty close to 90%. And we've talked a lot about the rally off the lows for the Canadian market, which has been outperforming the U.S. benchmark so far this year. How do you feel about the room for upside, if you will, for stocks, given the climb we have already seen?
I'm going to sound like I'm contradicting myself here, but I do still think there's a lot of room to go here, John. I think in our view here on a macro side is that there's going to be room to grow here, both technically and on a macro side, cyclically, where we are in the cycle for another year or maybe even year and a half, or into the latter half of 2022, for a bunch of reasons. But largely, there is nowhere else to be other than stocks right now. The kind of equity risk premium, the difference between the dividend yield and the bond yield, especially in Canada, is kind of the highest it's ever been. So you almost have to be in stocks for a portion of your assets. Continued buying, continued liquidity, all the saving that is happening, the reopening, there's positive sentiment, manufacturing, we're catching up on a lot of these macro factors. So I think there's room to grow here, definitely. So I do think you continue to want to be long equities. Now, the proportion you should have Canada, US, global, I think might change, or should maybe change.
Walk us through what you're thinking. I mean, as sort of in terms of portfolio strategy, what do you think is the winning way to go?
Well, I've been heavy US for a long time in my career. Pretty much all of my career, I've been overweight US as a portfolio manager and overweight global relative to Canada. For the first time in a while, I'm starting to see some indicators that are telling me that Canada, and you've mentioned it earlier, we're outperforming this year, but that's not really kind of what concerns me. But the PEs that we're seeing on the US side, with an economy that's already reopened, whereby the PEs globally, specifically globally, I think there's an opportunity to outperform relative to the US. And for the first time in a while, we're looking at being overweight Canada, which hasn't happened in a while. I do think, the energy, the reopening, the commodities, where we are, cyclicals, RTSX relative to the US, right? You're looking at cyclicals continuing to outperform defensives in the future. So that all creates an atmosphere, kind of a perfect storm for Canada to continue to outperform over the next, or potentially outperform over the next 6 to 12 months.
And when we're talking about defensives, and mind you, I start to get confused on how we characterize certain stocks. It felt like those biggest of big technology companies started to be described as defensives. I bring them up only because we've heard cyclical. I feel like for weeks and weeks, a lot of the strategists, and that has been a winning bet, but I'd say over the last week and a half, a lot of our guests have started to point to some beaten up technology stocks and suggested maybe taking a second look. So is there a pocket of that growth portfolio, if you will, that you're still intrigued by?
I'm always going to own Alphabet, for example. Like that's a stock, unless they dramatically change what they're doing, they control the information. They're trading at a less than 30 cap. They got 20% compound growth. Like, why would I not want to own that stock every single year, in perpetuity? And I've been saying that on BNN for a very long time. So I do want to continue to hold the good growth names, I guess the defensive growth names, if there's such a thing as that. But I do want to continue to own those. By no stretch would I ever advise anyone to go completely out of growth or completely into value or completely into cyclicals or not. It's a slight shift when we manage money. So I'm never talking, we're not a hedge fund here. So we're not going to make kind of those macro calls that are all in, all out. We're not at the casino here, right? We're managing assets for individuals. So when I'm talking deep cyclicals versus deep defensive, energy materials relative to staples, utilities, and industrials, financials relative to telcos, REITs.
All right. An investor with conviction, a sports fan with conviction, as we can tell from that Winnipeg Jets jersey behind you, Mr. Tetreault.
Yeah, it's been tough here in the last while. You guys got beaten by the Habs, and then I had to deal with this at my end. I don't know who had it more painfully, John. You guys, the comeback, or us, 4 straight. But regardless, it's been tough here in Winnipeg since our Jets are out. So now we can focus exclusively on the market. If you're looking at, there's still room, I think, for some commodity plays in Canada, and definitely energy. If you don't have energy plays in your portfolio, unless you're opposed to it philosophically, you should own energy.
I love that pitch to your clients. I'm over watching hockey. I'm ready to get down to business. Rob, thanks very much. Rob Tetreault of Canaccord Genuity with his stock picks. And